Hey everyone, welcome to another homework help video. Today we're going to be going over chapter 11, which is on bonds. And we are going to go over the journal entries for the initial issuance of a bond, the payment of the coupons, and determine the interest expense for the year. And then we're also going to compute the price received for the bonds. We're going to recalculate this price and use it by using these present value tables to properly discount the cash flows expected from the bond to get the valuation on the issue date. And so this will be a pretty comprehensive example for this chapter. So on July 1st, Livingston Equipment Company, a wholesaler of manufacturing equipment, issued $46 million of 20-year 10% bonds at market interest rate of 11%. So they received cash of 42,309. The 46 million, this is the par value of the bond. And the par value of the bond is always what's going to be credited to bonds payable. So that's $46 million. And the cash that the company received is less than the par value of the bond because the interest rate that the market judged that this bond should receive is less than the coupon rate that the bond is paying. So because the bond is paying less interest than the market rate, the bond has to be discounted so that the cash flows over the period of the bond, including the repayment of the face value on the maturity date of the note 20 years later, has to give investors an effective interest rate of 11% on their investment. And so the cash received is 42,309,236 because that's given to us. And to calculate the discount, we need to balance our debits and our credits. And so we take 46,000 or 46 million minus 42,309,236, and we get 3,690,000. And that is discount on bonds payable. Now we're going to journalize the first interest payment on December 31st, and we are going to use the straight line method, which is not a gap method, but it simplifies the calculations for us in this homework problem. And how we are going to amortize the discount on the bonds payable, we are going to divide the 3,690,000 amongst all the payments that are going to be made over the course of the bond. And this is a 20-year bond that pays 10% interest due semi-annually on the 31st and the 30th. So there's actually going to be 40 payments because 20 years times 2 payments per year is 40 payments. So we're going to divide this by 40, and we get 92,269 in amortization every 6 months. But that's not the interest charge. The interest is going to be the amortization of the discount plus the cash that's paid. And because to create the discount, we needed a debit. To reduce the discount, we need a credit. And so this 92,269 is going to be a credit. And that's going to be discount on bonds payable. Our debit is going to be interest expense, and cash is also a credit because cash is being paid out for the coupon. And to figure out how much cash is going to be paid each coupon date, we need to take our $46 million face value or par value and multiply it by 10% effective interest rate. which so 0.01, and then divide it by 2 because it's a semi-annual payment, and we get $2,300,000 in interest. And then we need to add 92,269, and we get 2,392,269. And we are actually rounding to the nearest dollar in all of these. So we are going to take out the 10 cents that we had on the discount on bonds payable. Remember, round to the nearest dollar. In year 2, the amortization of the bond, what is the journal entry? So because payments are made every 6 months, it happened to end up exactly aligned with year end because the fiscal year of the company is the calendar year. We don't have to do anything with interest payable or accrued interest or anything like that. We're expensing this interest as we pay it. And so the journal entry is going to be exactly the same for the second coupon payment. And that's because we're using the straight line method. And under the straight line method, our interest expense is going to be the same every single period. Under the effective interest method, with a discounted bond, the principal, the carrying value of the bond slowly increases, and the interest is computed on the carrying value of the bond in the market or the effective interest method. And so then the interest would gradually increase over time. If it's issued at a discount, if it's issued at a premium, the interest would slowly decrease over time as the carrying value of the bond decreases over the life of the bond. Determine the total interest expense for the first year. That would just be the first 6 months of interest that was paid. And will the bond proceeds always be less than the face amounts when the contract rate is less than the market rate of interest? Yes, because the cash flows need to be discounted so that the total return of the bond is the same as the market rate of interest. And we're going to do some of the calculations now to calculate the present value at the face amount, present value of the semi-annual interest payment, and then the total proceeds of the bond issue. And ideally, the price that we come to is going to equal 42,309,236. That's what this is saying, but we have to recalculate that. How we calculate the present value of a bond is by using the present value at compound interest and present value of an annuity. And present value of compound interest uses this formula, 1 divided by 1 plus I time, and then to the nth power. This is our formula. And what we need to do is calculate at the market rate of interest and the present value of those cash flows. The face amount cash flow is 46 million, and that's going to be paid one-time payment after 20 years. And so we have to discount that at 11%. So the face amount, and because this pays semi-annually, we need to compound the interest rate of 11% 2 times per year. How we effectively do that in these calculations is we increase the number of periods and reduce the interest rate that we use for the calculations. So because we are calculating interest twice per year, there are 40 6-month periods now until the maturity date, and the interest rate each period, the every 6 months interest rate is 5.5%. And so for our calculation, we are going to multiply the $46 million times 5.5% for 40 years, which is, oh, and this is the present value of an annuity table. This is the present value of $1 at compound interest. And so we are going to do 5.5% over 40 years is 0.11746. And again, that's right here, 0.11746. And we get the present value of the face amount at the end of the period is 5,403,160. To calculate the present value of the semi-annual interest payments, first we have to know what the interest payment is. We calculated it at $2.3 million. That was in each of our journal entries. And again, that's $46 million times 10% interest per year for the coupon rate times 0.5 because it's every 6 months. So we have 2.3 million. Now we need to multiply that by the present value of an annuity. We have 40 periods of coupons, 46-month periods in a 20-year bond, and we have a market rate of 5%. And so the discount rate is 16, or the present value factor for this annuity is 16.04612. And then if we add these together, 5,403,160, we get 42,309,236. And that is the same amount that the bond got issued for at the market rate. So thank you, everybody. That is how we create the journal entries for issuing a bond, paying the coupon payments, determining the interest expense for the full year, and also computing the price received for the bonds ourselves based on the present value of $1 for the face amount and the present value of an annuity of payments for the interest payments. We value those separately because it's different formulas. Thank you, everybody. I will, and good luck on your homework.